Nope, I don't.
My name is Stanley, and doing a financial analysis for Finance 381 on three companies. Three companies I chose to do a financial analysis was Hornbeck, Sternberger and Company, and Cabela's. Hornbeck is an offshore oil industry company. Sternberger and Company produces firearms and other hunting accessories, and Cabela's is your retailer for any of your hunting equipment, gear, anything like that. So for the analysis, we're going to look at, first off, a 6-month loan to the companies. We're going to look at the cash ratios, the quick ratios, and the current ratios. So we're going to start off with Hornbeck. Over the 5 years, they had some pretty good numbers across the board. What we mainly want to focus on is the cash ratio. As you can see, 2010, they were fair, and then 2011 they went up, but in 2012 they dropped off, but they went up a little bit, and they were looks good across the board. Sternberger and Company, they're not that well off as far as liquidity goes with their cash. As you can see, for their cash ratio, they started off good, but over time, in the past 5 years, they've steadily gone down, which isn't a good sign of for the company. Cabela's, if you look at it, for the cash ratio, they started off pretty terrible, and they're ending terrible, worse than what they started off. So, looking at all those ratios and which company I would make the 6-month loan to, without a doubt, it would be Hornbeck. Next off, we're going to do a 5-year loan with the company, and we're going to focus on the equity multiplier and the times interest earned. With the equity multiplier, it's going to measure how much risk they're taking with their company, and the times interest earned is if they're able to pay their debt back. So looking at the companies, starting off with Hornbeck, you see Hornbeck's keeping a steady. They're not taking much risk, and their times interest earned in 2011, they had a little bit harder time paying back those debts, but as you can see, as the past 3 years have gone by, they're working real well with that, and they're able to pay back their debt without a problem. Now with Sternberger and Company, they look great across the board. They're not taking hardly any risk with any of their company, but as you can see with their times interest earned, you see excellent numbers across the board, and they're easily able to pay back their debt without a doubt. Now Cabela's is taking a lot more risk than both of the other two companies, and they're paying back their debt easy, but with the amount of risk they're taking, you just don't want to look at something like that. So without a doubt, you're going to want to lend to Sternberger and Company for the 5-year loan, because they would have an easy time paying that back, and they're not taking as much risk with their company. So lastly, I'm going to talk about which company I would purchase 50% of the company, or the stock, the majority of the stock in the company. And we're going to look at the profit margin, and how much the company keeps per dollar. The total asset turnover, you want this to be high. It's just saying how efficient they are with their asset. You want to look at the equity multiplier again, how much risk they're taking for the company. ROE is going to be a key one. And looking at which I would want to purchase, and this is going to tell you how much they're giving back to shareholders. Return on assets is also how efficient they're being with their assets, and the price to earnings ratio. So let's look at Hornbeck first. As you can see, their profit margin is it was good in 2010, but in 2011 kind of dropped off, and then as you go on, it increases. The asset turnover wasn't that high, so they're not being as efficient with their assets, so that's not a good thing. Your equity multipliers we saw earlier, they're taking a little bit of risk, not too much, but the return on equity, as we look at it, they were generating real good to their shareholders in 2010, but in 2011 they went negatives, and that's never a good thing. So you don't want to. That kind of throws that under the bus. And then you have your return on assets. As you can see, 2011 they were negatives as well. That's never good. And then they've gone up. It's just fluctuated over time. Next is Stanley and Company. Their profit margin is pretty high, and they're giving a lot back to shareholders. Total asset turnover, they're being pretty efficient with their assets, which is good, is what you want, and they're not taking a lot of risk, so they're doing good there. The return on equity is looking great all across the board. Except in 2014, it kind of dropped off a bit, but other than that, it's doing real well. Return on asset is also, they're being efficient with their assets, which is always a good thing to see. And you see their price to earnings ratio is good. You don't want that. You want it high, but you don't want it too high on that. So Stanley Company's doing real well with that. Lastly, we have Cabela's. Cabela's is doing all right with all their profit margin. It looks good. They're doing pretty well compared to the other companies. Total asset turnover is not that great. You see it's below 1. You would rather have that high to show the company's utilizing their assets. Equity multiplier, like we saw earlier, they're taking a lot more risk than the other two companies, so which isn't that good. They're not getting as high of a profit for those risks. Your equity multiplier is pretty constant across the board, but it's not as good as the other two companies. Your return on equity reflects with the total asset turnovers. They're not utilizing their assets as well as they should be. And then you also have a price earnings ratio, which is kind of just projecting about how the company's looking in the future. From what it looks there, they're on the growth. They're growing. So who I would make the purchase, the 50% loan to, buy 50% of the company would without a doubt be Stanley.